So is this tech-driven rally running out of steam? Joining me to discuss is JPMorgan Private Bank's Abby Yoder. Good to see you. Thanks for coming down. So we're about to finish a pretty good month for the markets, which is coming at the end of about 4 months of one of the strongest rebound rallies we've ever seen. Risk appetites have rebuilt, all the rest. Does it make sense where we are to you right now? Is it built on a solid, set of assumptions about the outlook?
Yeah, I actually think it's been interesting. Obviously, there's been some valuation expansion. We're essentially back at like 22.5 times, which is where we were in January. But to your point, what we're like, is it on solid fundamentals? I would argue yes. Like 1Q came in better than expected. We're seeing 2Q come in even stronger than expected. So expectations were for 5% growth for 2Q coming into the quarter. Actually, as of last night, they were something like 7%, and now they're at 8.5% after the reports we got last night. So just really solid fundamentals in terms of, and we've seen a stabilization in terms of those earnings revisions. Yeah,
there's no doubt. I mean, the earnings have kind of played their part. I do wonder, though, when we say expectations, that was the formal consensus. The way stocks have reacted collectively to the numbers has not been universally positive, meaning maybe we kind of knew the beat rate was going to be pretty high. And I guess, if I look at how the market hesitated on Jay Powell's comments yesterday, if we're going to have to rethink this sort of interplay of growth expectations, inflation, what the Fed's going to do, does that set us back at all, or can we deal with it?
Well, I think the way that the market is thinking about this, if we look at price action, and it's like generally well known, and it's within our view, that you're going to see a slowdown from an economic standpoint in the second half of the year. But the market's looking at 2026 and thinking about that reacceleration and having policy clarity, right? Like we have more trade deals getting done. We've got the reconciliation bill passed, which is going to help in terms of a cash flow perspective for a lot of these large cap companies as they can immediately expense. So I think they're just looking past that slowdown, realizing that it's temporary in nature, and then focusing on these secular growers that are really taking.
Where within the market seems most, ripe to try and, put fresh money in? Because, we talk about this, the market's narrowed back out again in terms of the return attribution, in terms of the relative performance. Not that only a few stocks are going up, but the biggest stocks, the growth stocks, are going up the most.
Yeah, well, and I think that's a major concern around like concentration risk. But when they're backed by solid fundamentals, it's not necessarily a bad thing, right? But in terms of what we favor from a sectoral perspective, we like utilities, financials, and technology. So those are where we're really focusing. Utilities is going to benefit and kind of be like an ancillary trade in terms of the AI play. And financials, I think, are really interesting because we're just at the start of this deregulation period, right? Like the Fed just held this meeting with a bunch of bank CEOs last week talking about like hearing from them. What can we do to help? How can we simplify? And that's really just the start of that momentum in our view.
And then, the market has been expressing a tolerance of this 15% tariff level if that's where things largely settle out, even though we got these delays today with Mexico, and it seems still like a moving target. And maybe we're not going to necessarily have some final number, but the market is expressing comfort with the path.
I think the companies in the S&P 500 have shown over the last 2 quarters that they're very resilient. They've been managing through very complex situations for the past 5 years. This is nothing new. I mean, it's new, but it's, they've done this before. I think to your point, though, like there are definitely, obviously, and we saw this today, sectoral issues at play that are still unknown that could pose big threats in terms of fundamentals for certain sectors like healthcare.
Yeah, I was going to say, you didn't mention healthcare as a favored sector. And of course, the president was sort of sent these letters out asking pharmaceutical companies to lower drug prices. It's a familiar, refrain in terms of that particular thing. But healthcare really is, on the outs with investors, and it's trading at a low relative valuation. So how do you view that?
I mean, healthcare is the lowest weight in the S&P that it has been since the tech boom, tech bubble, right? So 25 plus years. But unfortunately, it's somewhat warranted, right? Like you're having, not only do you have this drug pricing issue in terms of most favored nation that could really hurt the pharma and biotech, which is 50% of the sector, you also have issues in managed care, you have issues like kind of across the board aside from like medtech, for example, which is a growthier part of the index that we do like, but it's just kind of a multitude of policy uncertainty across all of these different businesses that make us think, okay, that might be an attractive valuation, but what is the earnings and how do you underwrite it makes us not really excited about it in the near term.
And clearly it's not, a tremendous, as you mentioned, driver of the overall index performance yet. So that being said, so you're kind of dealing with a target that's right around where the S&P is right now. Is that right? 6,300 at the upper end?
Yeah.
Does that mean you kind of dial ahead to next year and say, maybe we can build toward more there, or do we have to have some payback?
No, I think the way we're thinking about it, look, we have a bull case. So we have our base case, to your point, that's around that level, around the level we're at today, but our bull case is something like 7,000, right? And the way you get there is you see increased adoption of AI across all of these various industries, like financials, for example, that results in better revenue growth and better margin profiles, right? So that garners in of itself better EPS growth, but also a higher valuation if you have those wider margins. So that is like something that we're trying to parse through in terms of like, are we leaning more towards that? Obviously, we want to get through earnings before we make that decision.
Get through earnings, get through August, see how it all plays out. Abby, thank you.
Thank you.